All right. Hello, class. Okay, so we're going to talk about chapter 2 today, which is the financial market environment. And within this chapter, we are going to look at the following learning goals. Understanding the role that financial institutions play in managerial finance and the role that those markets play in managerial finance, as well as differences between the money market and the capital market. We also want to understand the major regulations and regulatory bodies that affect those financial institutions and markets. We also want to describe the process of issuing common stock, including the venture capital, going public, and the role of the investment bank, and understand what's meant by those financial markets in crisis. And we're going to be able to describe some of the root causes of that Great Recession. So starting out with financial institutions, they are intermediaries that channels the savings of individuals, businesses, and governments into loans or investments. The key suppliers and demanders of funds are individuals, businesses, and governments. And in general, the individuals are the net suppliers of funds, while businesses and governments are the net demanders of funds. We have commercial banks, investment banks, and the shadow banking system. So we're going to talk about each of these. Commercial banks, those are institutions that provide savers with a secure place to invest their funds and that offer loans to individuals and business borrowers. Those are everyday banks, kind of like the ones that we see here in town. We have Lions, we have Five Star, Wayne, and then Servue is actually opening up too. Investment banks. They assist companies in raising capital. They advise firms on major transactions like mergers or financial restructurings, and they engage in trading and market making activities. A shadow banking system is a group of institutions that engage in lending activities like traditional banks, but they don't accept deposits and are not subject to the same regulations as traditional banks. So if we look at the consolidation in the U.S. banking industry, it's been going through a long period of that. So according to the FDIC, which is the Federal Deposit Insurance Corp, the number of commercial banks in the U.S. declined from 14,400 in early 1984 to only 4,492 by October of 2019. This is a decline of almost 69%. It's concentrated among those smaller community banks, which larger institutions have been acquiring at a rapid pace. So this leads us into looking at the relationship between an institution and a market. So the financial markets, again, they're forums where the suppliers of funds and the demanders of funds can transact those business directly. So transactions and short-term marketable securities, they take place in a money market, while transactions in a long-term securities take place in capital market. A private placement involves the sale of new security directly to an investor or group of investors. Most firms, though, are going to rely on raising money through public offering of securities, which is the sale of either bonds or stocks to the general public. The primary market is where the financial market and the securities are initially issued. So this is the only market in where the issuer is directly involved with the transaction. In secondary markets, those are financial markets in where pre-owned securities, which those are not new issues, those are where it's trading. So here's an example of flow of funds. So for example, if we look at the suppliers of funds on the left-hand side over here on this side here, we take a look at, the funds go into the financial institutions, and those funds can get carried to the demanders of funds. And those funds then can be sent through private placement, or they can go down to financial markets in the form of securities. So we look at how the funds can move around from suppliers to those banks, to the demanders of funds into financial markets or securities, and those funds can then go back to the demanders, which then create loans for your regular individuals or businesses. And they will then send deposits and shares to the suppliers of funds. So again, you can just see how the flow of funds takes place between funds, loans, securities, and all of the different types of demand supply, private versus your financial institutions and those financial markets. The money market, this is where the investors are trading highly liquid securities with maturities in 1 year or less. Most of these transactions are made in what are called marketable securities. They are short-term debt instruments. We have examples like U.S. Treasury bills issued by the government, commercial paper issued by businesses, or negotiable certificates of deposits issued by financial institutions. Those are your bank CDs. Usually they're like a 6-month CD or a 9-month CD. They're less than normally a year. Investors are going to consider those market securities to be among the least risky available because that's a short return on that debt instrument. So again, say you put in 5,000 to a bank CD, you're going to make 6% only for that short period of time, which is not going to be a lot of money if you would have held it throughout the entire longer type of long-term debt instrument. In euro currency market, this is the international equivalent of our domestic money market. So it's a short-term bank deposit denominated in US dollars or other major currencies. And usually these deposits are all time deposits. So the bank promises to repay the deposit with interest at a fixed rate in the future, for example, like 6 months. And during the interim, the bank's free to lend that dollar deposit to credit-worthy corporate or government borrowers. If the bank cannot find a borrower on its own, it might lend that deposit to another international bank. The capital market. This is a market that enables suppliers and demanders of long-term funds to make decisions. So again, we're talking about long-term funds. So the key securities that get traded here are bonds and stocks. So securities traded in the capital market fall into two broad categories, debt or equity. Bonds are long-term debt instruments used by businesses and governments to raise large sums of money, generally from a group of diverse lenders. And when we look at bonds and stocks, we can take a look at common stock and preferred stock. So common stock are units of ownership, interest, or equity in the corp. Preferred stock is a special form of ownership that has features of both bonds and common stock. And when we're looking at the capital market, we can look at broker markets and dealer markets, where we look at security exchanges. So those are organizations that provide the marketplace where firms can raise the funds through the sale of new securities and where purchasers can resell those securities. We can look at broker markets. Those are where we have security exchanges where the two sides of a transaction, the buyer and the seller, are going to be brought together to trade their securities. This usually takes place on trading floors of national exchanges like your NSYE, Euronext, as well as regional exchanges. There are dealer markets, so markets like NASDAQ, and where the buyer and seller are not going to be brought together directly, but instead have their orders executed by security dealers who make those markets and given security. It has no centralized trading floor. It's made up of a large number of market makers who are linked together, usually via a mass telecommunications network. As compensation for executing those orders, market makers are going to make money on the bid and ask spread, or the ask price and bid price. The ask price, that's the lowest price a seller is willing to accept for a security, and the bid price is the highest price a buyer is willing to pay for a security. So when we talk about the spread, we're going to take that ask price and subtract that bid price. And that's the bid ask spread that the money maker is going to make for commission. So here's an example. Mark instructs his broker to submit a market order to buy 100 shares of Facebook common stock. At the time, the ask price is $168.79, and the bid price is $168.71. Remember, the ask price is the lowest price offered in the market to sell Facebook to a potential buyer. Since Mark's trying to buy Facebook stock and he wants to buy it at the lowest price possible, he's going to pay $168.79 plus whatever the commissions his broker charges. However, if he already owned Facebook stock and wants to sell it, he'd be looking for the market's best offer to buy the bid price. In that case, he's going to sell for $168.71, less commissions charged by the broker. Another example, assume that the current bid price for Merck & Co. stock is $83.55 and the ask price is $83.99. Suppose you have an E-Trade brokerage account that charges $25 commission for equity trades placed through a broker. So what's the current bid-ask spread for Merck? Remember, we're looking at ask minus bid. So we're going to take the $83.99, the ask price, and we're going to subtract the $83.55, the bid price, and we're going to see that the spread is 44 cents. So if we insert the current bid and ask prices into equation 2.1 that we find for Merck, it's 44 cents. What are our total transaction costs going to be if we purchased 100 shares of mark by submitting a market order via our E-Trade broker. We're going to assume that the trade is sent to the broker market for execution, and the market maker matches your order with a 100-share sell order from another investor. In this case, your order is going to be executed at the midpoint of the bid-ask spread, so 83.77. So you'll only pay the brokerage commission. So the total transaction costs are equal to that brokerage commission of $25. Now, what would your total transaction cost be if you purchased 100 shares of Merck by submitting a market order through your E-Trade account and it's routed to a dealer market for execution? So now we're going to have to look at that bid-ask spread. So our total transaction costs equal the number of shares times 0.5 times the bid-ask spread plus our brokerage commission. So we're looking at 100 shares, so 100 times half or 0.5 times that 44 bid-ask spread that we found earlier plus $25. So our total cost is going to be $22 plus $25 is $47. So depending on where your brokerage routes your order, you might find that your transaction costs are either going to be that $25, that commission for the brokerage in a broker market, or $47 in a dealer market. So make sure you look at which market you're going into. According to the World Federation of Exchanges in 2020, the world boasted 77 major stock exchanges with a combined total market value of $88 trillion. The largest stock market in the world is measured by the total market value of securities listed on that specific market is the New York Stock Exchange, with listed securities worth more than $24 trillion, or about 27% of the total market value for all major exchanges globally. The New York Stock Exchange total market capitalization is larger than the total market capitalizations of the world's 50 smallest major exchanges combined. The next largest is the NASDAQ at $11 trillion, with exchanges in Tokyo and Shanghai not far behind at $6 trillion and $4 trillion. So when we look at the capital market, we can look at international capital markets. So we have the Eurobond market. So this is where corporations and governments are going to issue bonds denominated in dollars and sell them to investors located outside of the US. A foreign bond market is where market for bonds issued by foreign corporations or governments that's denominated in the investor's home currency and sold in that investor's home market. An international equity market allows corporations to sell blocks of shares to investors in a number of different countries simultaneously. With this, we need to look at the efficient markets hypothesis. An efficient market establishes prices for those securities, which are stocks and bonds, by rapidly incorporating all available information. So a security price is an unbiased estimate of its true intrinsic value, correct on average. We have information in efficient markets. So prices respond to new information, and by definition, new information is unpredictable. That new information refers to things that the market participants don't know today and can't predict based on other information that they possess. So for example, here's Walmart's quarterly revenue from 2000 to 2020. We can see that it's steadily gone up. It's increased. And here's their stock price at the end of each quarter from 2000 to 2020. We can see that that actually has fluctuated quite a bit. It's gone up, it's gone down. It had a hit in 2016 and then rose back up. It looks like 2018, went down again 2019, and went back up again in 2020. So with the efficient market hypothesis, price movements in efficient markets is going to be what's considered a random walk hypothesis. It's the idea that an inefficient financial market prices are going to be virtually unpredictable because they're going to move in response to new information, which is unpredictable. So even if a company's financial results follow that highly predictable pattern, its stock price will not follow the same pattern or even any pattern. For example, we just looked at Walmart. If we go back, their revenue has increased steadily. However, the stock price is kind of all over the place. So again, this is the random walk hypothesis. If stock prices don't or do exhibit those predictable patterns, usually the actions of investors will tend to eliminate those patterns over time. The price of an individual security is determined by the interactions of those buyers and sellers in that market. So the stock price is the best available estimate of that stock's true value. Investors are going to compete with each other for information about that true value. So at any given time, the stock price reflects all known information about that stock. So the more efficient the market is, the more rapidly the whole process is going to work. And that relatively few professional managers outperform the overall market consistently is exactly what the efficient market hypothesis predicts. We can look at the behavioral finance challenge to these efficient markets. So behavioral finance is an emerging field. It's going to blend ideas from finance and psychology, arguing that stock prices and prices of other securities can deviate from their true values for extended periods, and those deviations may lead to predictable patterns in stock prices. We also need to look at the regulation in financial markets. So we can look at the Glass-Steagall Act. This is where it was prohibited institutions to take deposits from engaging in activities like securities underwriting and trading, which therefore effectively separate commercial banks from investment banks. The Federal Deposit Insurance Corp, or FDIC, is an agency that was created by that Glass-Steagall Act that provides insurance for deposits at banks and monitors banks to ensure their safety and soundness. The Gramm-Leach-Bliley Act, allows mergers between commercial banks, investment banks, and insurance companies and permits those institutions to compete in markets that prior regulations prohibited them from entering. The Dodd-Frank Wall Street Reform and Consumer Protection Act that realigned the duties of several existing agencies and requires existing and new agencies to report to Congress regularly. And nearly a decade after the Dodd-Frank became law, various agencies affected or created by the new law were still writing rules specifying how that new law's provisions would be implemented. So it's still 10 years after that became a law, there were still provisions about how it was going to be implemented. The Securities Act of 1933. This regulated the sale of securities to the public through primary market, and it requires sellers of new securities to provide extensive disclosures to the potential buyers of those securities. The Securities Exchange Act of 1934. This regulated the trading of securities in the secondary market. It created the Securities and Exchange Commission, or SEC. It requires ongoing disclosure by companies whose securities trade in those secondary markets. So that's filing a 10Q or a 10K. And it imposes limits on the extent to which insiders can trade in that firm's securities. So the Securities and Exchange Commission, this is the primary government agency responsible for enforcing the federal securities laws. There was a new Congress law that was called Stop Trading on Congressional Knowledge, or the Stock Act of 2012. This prohibits members of Congress from trading based on insider information they receive while performing their official duties. And it requires financial disclosures made by members of Congress to be posted in a searchable online database. Usually it's phased out 1 year later. Now we look at securities and how to issue them. So issuing common stock, this is a private equity. So an external equity financing that's raised through that private placement, typically by private early stage firms with attractive growth prospects. What we call them are angel investors, or angels. These are wealthy individual investors who make their own investment decisions and are willing to invest in promising startups in exchange for a portion of that firm's equity. We also can look at venture capitalists, or VCs. They are formal business entities that take in private equity capital from many individual investors, often usually institutional investors like endowments and pension funds, or individuals of high net worth, and make private equity investment decisions on their behalf. We can also look at organization and investment stages. So VC limited partnership is usually the most common structure. Here is an organization of that VC investors. So we have small business investment companies, or CBICs, financial VC funds, corporate VC funds, and VC limited partnerships. So small business investment companies are usually chartered by the government. They can borrow at attractive rates from the U.S. Treasury and use the funds to make venture capital investments. The financial VC funds are usually subsidiaries of financial institutions like banks to help young firms grow and become major customers in that institution. Corporate VC funds are firms, sometimes subsidiaries, that are established by non-financial firms to gain access to new technologies that the corporation can access to further their growth. And the VC limited partnerships usually are limited partnerships organized by those professional VC firms to serve as the general partner, organize, invest, manage, and use those limited partners funds to help liquidate the partnership, distribute the proceeds to all partners. So we can look at deal structure and pricing when we're looking at issuing common stock. So the deal structure allocates the responsibilities and ownership interests between the existing owners, which are usually the founders, and the venture capitalists. And its terms depend on numerous factors related to the founders, the business structure, the stage of development and outlook, and other market and timing issues. So usually VCs will require more equity ownership and pay less for the riskier and less developed the business. When we go public, we can either do private placement where our firms are going to sell securities directly to an investor or group investors. We can look at rights offering where the firm is going to share or sell those new shares to existing stockholders, or we can go public where we're going to share to the general public. What we need is an IPO or initial public offering. This is the first public sale of a firm stock, usually made by small, rapidly growing companies that either need that additional capital to continue to grow or have met a milestone for going public that it was established in an earlier agreement. We can look at prospectus. So this is a portion of security registration statement that describes the key aspects of the issue, the issuer, the management, and the financial position. We can look at red herrings. So this is a preliminary prospectus made available to prospective investors during a waiting period between the registration statements filing with the SEC and the approval. And then we can look at the quiet period. This is the period where the law places restrictions on what company officials can say about the company. With Roadshow, this is a series of presentations to professional potential investors around the country, sometimes going overseas, providing investors with information about the new issue. And these sessions can help investment banks gauge demand for the offering and set that preliminary offer price range. The investment bank's role in all of this, they take a look at selling new security issues and advising firms and promote that stock and facilitate the sale of the IPO shares. They also have underwriting, where the bank is going to bear the risk of reselling at a profit the securities purchased from that issuing corporation at an agreed upon price. We look at the IPO offer price for the investment bank. So again, that's where the price is going to be set by the issuing firm to sell those securities. The originating investment bank. So this is the initial bank that was hired by the issuing firm, which brings in those other investment banks as partners to form an underwriting syndicate, basically. So a shared risk. That underwriting syndicate, again, is a group of banks formed by the originating investment bank to share that financial risk associated with underwriting new securities. So another term to look at is tombstone. This is the list of underwriting syndicate banks presented in a way to indicate that that level of involvement by that bank located at the bottom of an IPO prospectus cover page. So if you're looking at stocks, if you look at the bottom of that IPO cover page, you should see all of those syndicate banks working together that have taken on this role. A selling group is a large number of brokerage firms that join the originating investment bank, and each accepts the responsibility for selling a certain portion of a new security issue on a commission basis. So, for example, here is a cover of a financial prospectus for a stock issue for Pinterest. I don't know if any of you have used Pinterest, but it's kind of like a image sharing app and website. So at the bottom here, you can see Goldman Sachs, JP Morgan, Allen & Company. They are the larger banks that have, bought into the shares and are offering the share to public, perhaps on the, public markets. And then there are other banks here, Bank of America, Merrill Lynch, Barclays, Citigroup, and whatnot. So you can see all the ones at the bottom of that prospectives here that are interested in being part of that syndicate group. So the selling process for a large security issue. So again, we have the issuing corporation and then the underwriting syndicate, which includes the investment banker, the original investment banker, however many investment bankers are involved in that underwriting group. It could be, like it shows here, 5, but it could be, only 2. It could be up to 10, 12. And then there's the selling group and then the primary market investors. So total proceeds. These are the amount of proceeds for all shares sold in the IPO, which is the initial public offering. So they are the IPO offer price times that number of shares issued. So that's our total proceeds. The market price is where we have the price of the firm's shares as determined by the interaction of those buyers and sellers in that secondary market. Market capitalization is the total market value of a publicly traded firm's outstanding stock. So with this, to calculate market capitalization, you're going to take the market price and multiply that by the number of shares outstanding. The IPO market price is the final trading price on the first day in the secondary market. And IPO underpricing is a percentage change from the final IPO offer price to the IPO market price, which is the final trading price on the first day. So it's also called the IPO initial return. So IPO underpricing is equal to market price minus offer price divided by that offer price. So the term underpricing applies because usually the offer price is set below what the secondary market investors are willing to pay. So here's an example. Investors are looking for a good night's sleep, might have been interested in the February 2020 IPO of Casper Sleep Inc. Known for its inexpensive mattresses shipped in a box easy enough for one person to handle, Casper offers its shares to primary market investors at $12. After one day of trading, the stock closed at $13.50, which means that they underpriced their shares by 12.5%. So again, we're going to take the closing price of $13.50 subtracted by the initial $12 and divided by that initial $12 to get our percentage rate of 12.5%. So the underpriced of 12.5% is considerably less than a usual 28% underpricing for Pinterest. So it demonstrates another interesting fact about IPOs where we're looking at the degree on how they're underpriced. It varies one deal from another and one time to another. Usually smaller IPOs are underpriced more than larger ones, but that's not the case here. They raised about $100 million in its offering, Casper did, which is a fraction of the $1.4 billion raised by Pinterest. We can look at the financial institutions and real estate finance as well. So securitization. This is the process of pooling mortgages or other types of loans and then selling claims or securities against that pool in the secondary market. A mortgage-backed security, that represents claims on the cash flows generated by pools of mortgages. This is a primary risk associated with mortgage-backed securities is that homeowners may not be able to or may not choose to repay their loans. Falling home prices and delinquent mortgages. So the rising home prices between 1987 and 2006 kept mortgage default rates low. Lenders relaxed standards for borrowers and created those subprime mortgages. As the housing prices fell from 2006 to 2009, many borrowers had trouble making those payments, but they were unable to refinance. So we had what was called the housing bubble of 2008. As a result, there was a sharp increase in the number of delinquencies and foreclosures. And we had subprime mortgages, which are mortgage loans made to borrowers with lower incomes and poorer credit histories as compared with our prime borrowers. So there was a crisis in confidence in the banks. With that delinquency rate rising, the value of mortgage-backed securities began to fall, and so did the fortunes of many financial institutions that had invested heavily in those real estate assets. Only 3 banks failed in 2007, but 25 failed in 2008, 140 failed in 2009, peaking at 157 bank failures in 2010. It wasn't until 2015 that those bank failures fell back into the single digits. So there were spillover effects and recovery from that Great Recession. So as banks came under intense financial pressure in 2008, they began to tighten their lending standards, dramatically reduce the quantity of loans they made, and increase the rates that they charged borrowers. Corporations found that they couldn't raise money in the money market or could only do so at extraordinarily high rates. So as a consequence, businesses began to hoard cash. They cut back on expenditures and economic activity contracted. And then we look at the pandemic effects on the financial markets. So on January 11th, 2020, the Chinese state media reported the death of a 61-year-old man who had died from an unknown virus that had infected many others in Wuhan. And just 10 days later came the first confirmed case in the US, and soon dozens of countries reported outbreaks. By March 13th, President Trump declared a national emergency, and within days, many states issued shelter-in-place orders to residents and shuttered non-essential businesses. The effects on the financial markets were immediate and dramatic from this. The S&P 500 stock index, which had peaked in February, fell in 17 out of the next 23 trading sessions, dropping by more than 30%, perhaps the most rapid decline in stocks in the U.S. history. Yields on investment-grade corporate bonds, a measure of what it costs to be financially sound for companies to borrow money, rose from 2.36% to 4.12% in 2 weeks. For companies with less than stellar financing, borrowing costs soared from 6% to more than 11%. So we took a look and understood the role that financial institutions played in managerial finance. So they help bring net suppliers, funds, and demanders together to help translate savings from individuals, businesses, and governments into loans and other types of investments. The suppliers are usually the individuals or households who save more money than they borrow. Businesses and governments are usually the net demanders of the funds, so they borrow more money than what they save. We understood the role that financial markets play in managerial finance. So financial markets help businesses raise those external financing that they need to fund new investments for growth. They provide a forum where savers and borrowers can transact that business directly. They issue debt and equity securities directly to the public in that primary market. We have subsequent trading of those securities in a secondary market. We also learned to describe differences between the money market and the capital market. So again, in the money market, savers are going to want that temporary place to deposit funds where they can earn interest, have a short-term need for funds. So again, those are your CDs, those short-term opportunities for you to gain some slight capital. Marketable securities like treasury bills, commercial paper, and other instruments, those are the main securities traded in that money market. The euro currency market's the international equivalent of the domestic money market. In contrast, our capital market is where the savers and borrowers are going to interact on a long-term basis. So money market, short-term, capital, long-term. Firms are going to either issue bonds or stock, debt, or equity securities in the capital market. And once issued, those securities can be traded on those secondary markets through either broker markets or dealer markets. Remember, broker markets are usually cheaper. The dealer markets are usually more expensive because you have that asked bid price. An important function of the capital market is to determine the underlying value of the securities issued by businesses. And in an efficient market, the price of a security is an unbiased estimate of its true value. We learned to understand the major regulations and regulatory bodies that can affect financial institutions and markets. The Glass-Steagall Act created the FDIC, imposed separation between commercial and investment banks. It was designed to limit the risks that banks could take and to protect depositors. More recently, the Gramm-Leach-Bliley Act repealed elements of the Glass-Steagall that were pertaining to the separation of that commercial investment bank. After the recent financial crisis, a lot of debate occurred regarding popular regulation of large financial institutions. So with that, we looked at the Dodd-Frank Act, passed in 2010, and that contained a host of new regulatory requirements, and the effects of that are yet to be determined. The Securities Act of 1933 and the Securities Exchange Act of 1934, major pieces of legislation that reshaped financial markets. The 1933 Act focused on regulating the sale of securities in the primary market, and the 1934 Act deals with the regulations governing transactions in the secondary market. The 1934 Act also created the SEC, which is responsible for enforcing those federal security laws. We also looked at the issue of issuing common stock, including venture capital, going public, and the role of that investment bank. So the initial external financing for business startups with attractive growth prospects typically comes through private equity raised through private equity placement. So these investors are either angel investors, again, those wealthy people, or those venture capitalists, the VCs. Those VCs usually invest in both early stage and later stage companies that hope to take public to cash out their investments. And that first public issue of a firm stock is called the IPO, or initial public offering. The company selects the investment bank to advise and to sell those securities, and the lead investment bank may form a selling syndicate with other investment banks. Again, that's that underwriting syndicate. The IPO process includes getting SEC approval, promoting the offering to investors, and pricing the issue. And finally, we looked at understanding what it's meant by financial markets in crisis and some of the root causes of the Great Recession. So the financial crisis was caused by several factors relating to investments in real estate, where financial institutions lowered their standards for lending to prospective homeowners, and institutions invested heavily in those mortgage-backed securities. So when the home prices fell and mortgage rates, not mortgage rates, but mortgage delinquencies rose, the value of that mortgage-backed security held by banks plummeted. A lot of banks failed, and a lot of others were restricted to their flow of credit. That in turn became known as the Great Recession. So that was chapter 2. We will look at chapter 3 next. So make sure to review, go through. If you've got any questions, feel free to send me an email or hop on one of the office hour Zoom calls. And we will take a look at chapter 3 next. And again, if you guys have any questions, please feel free to let me know. Thank you.